On January 27, 2026, 2 decades of stalled negotiations came to a quiet close behind the doors of Hyderabad House in New Delhi, binding the economic fate of 2 billion people together. To understand the basic mechanics of a free trade agreement, you have to look at the invisible barriers governing global commerce. For years, tariffs have functioned as a massive wall between India and Europe, artificially inflating the cost of goods on both sides. This new agreement demolishes that wall. Almost overnight, it strips away duties on nearly 97% of European exports heading to India, and drops tariffs to zero for Indian goods entering Europe. This effectively fuses together two distinct economies, creating a frictionless market that encompasses a full quarter of the entire planet's gross domestic product. By integrating these two giant markets into a single preferential zone, the agreement creates a calculated, long-term incentive to move production and sourcing away from traditional hubs and into this new corridor. Europe has spent the last few years grappling with a severe structural vulnerability. They rely heavily on foreign manufacturing, and they urgently need a democratic alternative to China to secure their supply chains. India has a reciprocal problem. New Delhi boasts a massive young workforce, but it needs deep pools of foreign capital and advanced European machinery to modernize its factories and actually employ those millions of workers. These overlapping vulnerabilities finally broke the 20-year diplomatic deadlock. Kiel Institute projections suggest the resulting deal will drive a massive surge in bilateral trade, expanding volume by up to 65%. This expansion hits a wide range of industries, clearing the path for high-end European engineering equipment flowing eastward and labor-intensive Indian goods moving west. Mutual vulnerability and the threat of global isolation finally forced these two distinct giants to merge their economic futures. To see how a macroeconomic treaty like this actually functions on the ground, we have to look at a mechanism known as the employment multiplier effect. It starts at the shipping docks. Because Indian exports now face zero tariffs in the EU, they are suddenly much cheaper for European buyers, triggering a sharp, immediate spike in demand for Indian goods. To meet new European demand, Indian factories must scale up by expanding capacity and building new facilities. This physical expansion requires labor. The hiring surge increases worker competition, ultimately driving up wages for both skilled and unskilled labor. There is also a secondary effect for consumers. With import taxes slashed from rates as high as 110% down to just 10%, everyday Indians gain access to European vehicles, luxury goods, and high-tech tools at significantly lower prices. This chain reaction targets the Indian working and middle classes, shifting the economic focus from corporate profits toward a long-term transfer of industrial wealth. The clearest winner in this arrangement is India's textile and apparel sector, an industry that already employs roughly 45 million people directly. Historically, Indian apparel faced European import duties of up to 12%. Dropping that number to zero instantly allows Indian manufacturers to outprice traditional low-cost competitors like Bangladesh and Vietnam. The export volume is also primed to surge in other critical sectors, specifically pharmaceuticals, IT services, and leather manufacturing, where Indian firms will gain friction-free access to European buyers. But the economic shift won't happen overnight. For the first 1 to 3 years, the most visible impacts will be headlines about European foreign direct investment and initial spikes in export orders. The heavy lifting takes time. It will take 5 to 10 years for this capital to mature into new factories, sustained industrial development, and noticeable income growth for the middle class. These industrial shifts are cumulative. The scale of this integration means the most significant gains will be realized through a decade of compounding growth in India's manufacturing capacity. Unrestricted access to the wealthy European market comes with a specific hidden cost. To sell their goods, Indian manufacturers must meet the European Union's notoriously strict environmental regulations. The primary obstacle is a policy known as the Carbon Border Adjustment Mechanism, or CBAM, which functions as a strict carbon tax on imported goods. This specifically threatens India's carbon-intensive exports, like steel and cement. It places Indian manufacturing enterprises in a high-stakes race to modernize their energy sources, or risk being priced out of the European market entirely. By leveraging its massive consumer base, Europe is actively forcing a costly but necessary green transition onto India's heavy industry. Behind the environmental and economic clauses, there was a specific global pressure that finally forced New Delhi and Brussels to sign the paperwork: the threat of rising U.S. protectionism. The prospect of 50% tariffs on exports sent a clear signal to both regions, proving to leaders in both capitals that they desperately needed to establish strategic economic autonomy. The trade agreement provides that autonomy, but it runs parallel to new maritime defense pacts and the massive India-Middle East-Europe economic corridor. This pairing, European capital and technology matched with Indian labor and scale, is designed to function as an integrated engine for the next phase of global growth. This partnership establishes a critical foundation for India's stated goal: transforming into a fully developed economy by the centenary of its independence in 2047.